workforce demographics in the long run. And here going forward for the next 20, 30 years, there's a slower growth in the workforce because our baby boomer generation is coming towards retirement. And we're going to need our workforce as it comes in, graduates from high school and college and other post-secondary opportunities, to be as productive as possible to help support the growth in our economy. It's also going to be a more diverse workforce. Nationally, we have more languages that are being spoken among our various young children. A number of immigrant families have moved into our country too, and that these are children who are going to come forward. And the workforce of 20, 30 years from now is going to be a richer, diverse workforce in our country, and how we can help those children today who are very young come to school prepared, and then think 20 years from now, those are the kids who are going to be working in our businesses, in our healthcare system, our education system. They're going to be our next engineers,
right,
our next scientists. And so the more we focus on the return to human capital, which is a true return, and now I know that we found that there were some false returns to certain financial instruments that were invested in the past few years, but the return to human capital we can count on.
That's a great way to put it. I think that helps people understand why someone an economist from the Federal Reserve Bank, working with his peers at the Federal Reserve Bank, would spend this amount of time and this amount of energy focusing on early childhood education. And I know you've written articles, there have been several publications, you speak. We bring you to Michigan, probably one of your most frequent visits, but we've asked you to come to Michigan several times, and you've graciously come each time and spent time with our policymakers, our legislators who are making policy going forward, to help us deal with the issue of the economy, but also to help us deal with it wisely, because this is an investment for our future.
That's great.
And the return to human capital is a good way to put it, I think, because most people don't think about economists, especially from the Federal Reserve Bank. Not that you're a geeky group of people, but you're a very important part of our economy in this world. But that most people don't think about the Federal Reserve Bank being interested in particularly education, let alone early childhood education. So I commend you for the work you've done on this. And while we do have, I think, a couple of minutes left, would you explain how you got to early childhood education? I mean, to me, that seems to be a little bit of a leap that suddenly, or well, maybe you didn't do it suddenly, but that, you know, we're getting publications from the Federal Reserve Bank talking about the return to the community, to the state, to the nation on the dollar by investing in early childhood education.
Sure. So the Federal Reserve, as I mentioned before, primarily focused on how the monetary system works. But we have a number of economists in of course, each of the 12 Federal Reserve banks around the country. And we look at a number of areas of research, not just money and banking, but how economies grow. And might even look at particular markets or segments of the economy, such as the retail sales in the economy, or construction, or international trade. And this particular piece of research was looking at how we think of traditional economic development initiatives. And what often comes to mind in the name of economic development is the use of public resources or incentives to encourage companies to move to a local area, to a city or a county or a state. And what our director of research at the Federal Reserve Bank of Minneapolis, where I work, Art Rolnick, what he found is that this type of competition that we see between local governments and state governments wasn't, from a national perspective, gaining new net jobs. We just saw jobs moving from one location to another. Millions of dollars were promised to companies to come into their local area. And so we questioned, how could we use these resources better and in the name of economic development? And for a number of years, we have written about the importance of investing in our K-12 system in our colleges and universities as a way to get to that productive workforce. And while we still believe that these investments are very important, what brought us our awareness to these early years was simply exposure about 6 years ago to a presentation on the importance of the very first years in the development of a young child's brain, and also these key economic studies that I studied, these cost-benefit analysis studies. And after we reviewed the research, we found and did some of our own tabulation and came up with some calculations, we became convinced that in the name of economic development, a dollar spent in early childhood would have the highest return. So that really started us in this direction. In the past 6 years, we found that our framing of the issue, our insights in the issue have been, other people wanted to hear about it, so we've kept our work in this area.
And what is that return? I know you talked about some figures last night when we were discussing this. Can you tell me just briefly what the return ratios are?
Sure. So what we did is we calculated what the annual rates of return are. So let's say you look at your savings account statement and you look to see how much are you making on your savings account or your CDs in a bank. I won't pick on the stock market for the past few months, but even the stock market over the long run has returned, once we adjust for inflation, 6% annually for over a 25, 30-year period or so. What we found in these long-term studies that have been conducted is that the rates of return on an annual basis can range from 7 to 20%, and that's a very high rate of return, most of that return accruing to the general public. And so once we did those calculations, found that these rates of return were very high, even relative to investments in the stock market and private equities, we became convinced this was a high return. And believe me, when I present these figures to an audience of business people, and they often are, every day, they're thinking about, well, what's our rate of return? Their eyes open up and they understand, they get it, that yes, if we invest in our kids early, we'll get this high return from a public point of view.
Well, that's a great story, obviously a story for not only policymakers in Lansing to look at, but it's also important for parents, for educators in our communities to look at what we can do as a state to invest in our future. So I want to thank you, Rob Grunewald from the Federal Reserve Bank in Minneapolis, for joining us today and for coming to Michigan and help sharing with legislators so we can learn from you and the work you've done. And I want to thank you, our audience, for joining us again today at Lansing, from Lansing to the Lakeshore. I hope you will ask your legislators and your community members, your school board people, what they're doing for quality early childhood programs in your communities, and I hope you will encourage them, if they don't have any, to start them. If they do have some, to continue to grow, because they are wise investments for our future. Thank you and good day.